Right now, the entire world is witnessing the emergence of the single biggest market opportunity our generation could ever see. In much the same way that someone investing a couple of $1,000s into the S&P 500 decades ago might today find themselves sitting on a multi-million-dollar fortune, the chance to get involved in cryptocurrency presents a once-in-a-lifetime window to build extraordinary wealth. Sadly, most people remain unaware or unwilling to learn, and as a result, they risk being left behind while a select few capture the lion's share of the gains. But you, having stumbled upon this lesson, have an opportunity to join that elite 1%. Even starting small, you can lay the groundwork today to potentially become a millionaire in the coming years. Having spent the last 7 years trading full-time and 5 years fully immersed in the crypto space, I've distilled my experience into a straightforward, no-fluff guide designed to equip you with everything you need to get started. By the end, you'll understand the fundamental principles that underpin cryptocurrencies, the compelling case for both short and long-term investment, how to perform basic fundamental and technical analysis, multiple avenues for generating revenue, as well as practical tips for buying, selling, organizing, and securing your crypto assets. If you stay with me through to the conclusion, you'll emerge with a solid foundation, ready to think and invest like the top 1%. To get started, it helps to grasp what cryptocurrencies actually are. At their core, they provide a secure, transparent method of storing and transferring information that isn't controlled by any single entity. All transactions are recorded on an open ledger known as a blockchain, visible to everyone yet encrypted to ensure privacy and security. Because there's no central authority, trust is enforced by consensus mechanisms, and the ledger's immutability guarantees that once data is written, it cannot be altered. Within this vast universe of digital assets, a few key applications stand out. The most well-known use case is as a store of value embodied by Bitcoin. In an era of rampant currency debasement, when governments print money at such a rate that the purchasing power of traditional fiat currencies steadily erodes, Bitcoin offers a deflationary alternative. It has a hard cap of 21 million coins, rendering it immune to inflationary expansion. Moreover, it facilitates near-instant cross-border transfers without banks or governments acting as intermediaries, making it a fast and transparent vehicle for moving wealth. A second major category is decentralized finance, or DeFi, where programmable money transforms the traditional financial system. On networks like Ethereum, Solana, and Binance Smart Chain, developers deploy smart contract self-executing code that automates financial transactions. This creates an ecosystem where lending, borrowing, trading, insurance, and other financial services run autonomously, lowering costs and eliminating bottlenecks created by manual processes and centralized gatekeepers. DeFi's growth has already exploded, and its potential to disrupt banking, insurance, and beyond is immense. Stablecoins represent a third key pillar. These tokens peg their value to a fiat currency, most commonly the US dollar, offering a blockchain native equivalent of cash. Tether, USDT, and USD Coin, USDC, are two of the largest, each designed to maintain a constant $1 value. Stablecoins enable traders to quickly exit volatile positions into a dollar-like asset without leaving the crypto ecosystem, and they serve as the backbone for liquidity in DeFi protocols. Understanding these categories sets the stage for appreciating why crypto represents such a compelling investment. Central banks around the world have continued to expand their monetary base, diluting the value of their currencies. In the United States, for example, the purchasing power of $100 in 1900 has plummeted to the equivalent of mere dollars by 2020, after unprecedented money printing during the pandemic. We lose roughly 3 to 4% of our buying power annually. At the same time, the US dollar's status as the global reserve currency faces challenges. Historically, reserve currency status has shifted every century or so among leading powers: Portugal, Spain, the Netherlands, France, Great Britain, and indications are that China or others could eventually supplant the dollar in oil trading. Should that happen, the US could see its currency lose up to 30% of its value within months. drastically increasing import costs and ballooning national debt service obligations. Hyperinflation, astronomical interest rates, or massive tax hikes could follow. Even without an extreme scenario, the average American wallet has already shrunk substantially over the past century. Gold has long served as an alternative store of value, but it has drawbacks: lack of transparency about total reserves, difficulty in dividing or transporting, and no programmable features. It remains concentrated in the hands of states and large institutions, and although durable and historically proven, it cannot adapt to the digital age's demands. By contrast, Bitcoin and other cryptocurrencies excel in nearly every evaluative dimension. Verification is immediate and public, fungibility is perfect, and divisibility down to 8 decimal places means even microtransactions are feasible. Portability is as easy as carrying a seed phrase on a USB stick, durability is digital, supply is capped and predictable, and decentralization ensures no single actor can manipulate the system. Programmability enables a host of novel applications, from decentralized governance to automated yield strategies. For all these reasons, Bitcoin represents a paradigm-shifting upgrade over both fiat and gold. Its current market cap, roughly $1.3 trillion, still trails gold's $15+ trillion valuation by more than tenfold. Yet for Bitcoin to match gold, only a small fraction of the global money supply, about 15%, would need to flow into it, a scenario that would push one Bitcoin's price north of $1 million. In addition to the store of value play, the DeFi ecosystem's explosive expansion suggests that the next generation of high-growth tokens could easily deliver 50 to 100x returns or more. New blockchain networks and protocols, particularly those with strong developer communities and robust total value locked (TVL), often resemble early versions of today's giants. By analyzing metrics like TVL on platforms such as DeFiLlama, you can identify undercapitalized networks poised for massive growth. For example, Coinbase's Layer 2 protocol base already hosts over $1.6 billion in TVL shortly after launch, compared to Binance Smart Chain's peak TVL of $21 billion. Projects like Airdrome Base's analog to PancakeSwap currently trade at modest market caps relative to their fundamentals, suggesting room for significant appreciation if the broader market rallies. To navigate this terrain effectively, you'll need a grasp of tokenomics, the economic design of a token encompassing total supply, circulating supply, vesting schedules, and incentives. Tools like CoinMarketCap and CoinGecko offer centralized hubs for researching any token's market cap, supply metrics, FDV, fully diluted valuation, and project documentation, including white papers and vesting timetables. This allows you to assess dilution risks. If a token has a massive reserve locked away and scheduled to enter circulation over time, its price could face downward pressure as those tokens unlock. Comparative analysis tools such as MarketCap help calibrate expectations by simulating what a token's price would be at different market cap levels. If you see a token at 1 cent with a tiny market cap but significant potential to scale, you can estimate its price at the level of a larger token, providing a realistic upside target. Rather than chasing tokens priced at hundreds of dollars that offer little upside, focus on fundamentals, market cap relative to TVL, competitive positioning, network effects, and the quality of the development roadmap. Once you've identified promising projects, mastering technical analysis on platforms like TradingView can refine your entry and exit points. Key techniques include drawing trend lines to map support and resistance channels, applying Fibonacci retracements to predict natural pullback levels, and extending Fibonacci projections to estimate potential tops. These tools, combined with chart patterns and momentum indicators, can help you anticipate price movements. But if you want a simplified approach, consider 2 critical indicators: the on-chain cost of mining chart, which tracks the average expense to produce a Bitcoin and historically aligns with price bottoms, and the on-chain terminal price model, a quantitative forecast for Bitcoin's long-term valuation that often marks cyclical peaks. By buying near the cost of mining line and scaling back or taking profits as price approaches the terminal price line, you can automate a proven buy low, sell high strategy that, across multiple market cycles, has generated staggering returns.